Oh my god, what is happening to the stock market? As you can see right here, the S&P 500 is down by almost 2%. If you look at the past month, it's down by 7%. If we also look at the Nasdaq, it's also down by 7%, and the same is happening to the Dow Jones. So what is really happening to the stock market right here? Are we entering a recession, or is this just a minor correction that the stock market is expected to overcome, and what should you as an investor be doing? So welcome everybody to the Geeky Investor, where stocks talk and we translate. Today we're going to be discussing will the market crash and my personal opinion. So before proceed any further, let's look at something that is very interesting. All right, so I will be zooming out right here and now moving to this part. So as you can see right here, market fall definitions. So a minus 5% in the stock market is called a pullback. A 10% is called a correction. A 20% is a bear market, 35% is a market crash, and 50% is a market recession. So what are we facing right now? Now, as you just saw a moment ago here, the S&P 500 is down 7%, Nasdaq 7%, and Dow Jones almost 7% as well. So this is between the 5% and the 10% territory, which is what we call, a pullback market, and that is nearing a correction cycle. So is this routine for the stock market, or is this really extraordinary that really us as investors should be very, very worried about? Now, if we look at the statistics, this is a very, very important thing that you as an investor should develop the habit of really doing so. So what is, as we just said, 5% is a dip, or what is also called a pullback. So expect that almost every year. Now, if we look at the Nasdaq, for example, over the past 5 years, now as you can see right here, it was down by what? Let's say 9% right here in 2024, and then again in 2025, it was down by like 18%. If we go back in 2023, it was down by 9%. So as you can see, a dip of 5% or more is expected at least on an annual basis once every year. A 10% correction is seen every 1 to 2 years, so a year and a half typically, and then a 15% drop is seen every 2 to 3 years, and then finally a 20%, what we really call officially a market bear or a bear market, is really when that happens of a 20% discount to the stocks. It usually occurs every 4 to 5 years on average, depending on the source, if you're looking at the Nasdaq or if you're looking at the S&P 500. However, overall, what it is basically what we're entering right now is just a pullback that is really expected to happen on an annual basis. Now, the question really comes, will we enter a correction cycle, or will we dig deep into a bear market? That's really the real question. Well, to answer that, I will just cut to the chase and tell you the final thing. Well, nobody really knows if we're gonna still stay at a pullback dip, or if we're gonna really go to a bear market. Nobody really knows for sure. However, the idea is, before really thinking and before really committing your mind to these type of things and these expectations, you should be able to know if your investment is in the right price, if your investment is sound and has a good balance sheet and a good management that can really foresee this, or can overcome this particular matter that is happening to the world. So what is really happening from a financial and an economic perspective? I'm not going to go into the politics right here because really this is not my part, this is not my area. However, just one thing that I would like to highlight here, just the economic part of what is really happening. So as you can see, really this is what we call the Strait of Hormuz. So as you can see right here, this place is really affected, which holds and handles almost 20% of the world's total oil consumption. So really, that is really destined for markets in China, India, Japan, and South Korea. So as we know, so 20% of the total oil is passing and being handled through this tiny particular area. And this tiny particular area, there is a very small area at this place where only 4 miles of ships and cargo can be shipped and taken from one place to the other. So only 4 miles. So as you can see, it's a very tight regulatory turn-off switch that is really essential for the economy of the overall world. So even if these are mainly for China, India, Japan, and South Korea, well, the idea, if these countries have more expenses to pay on the total oil consumption, then of course their consumers and their other companies will increase the prices of their other products and services, and this would lead to what we call, as you can see right here, an inflationary ripple effect affecting everybody else, not just the primary countries that are affected. Now, if we also look at, as you can see right here, it is also the route of 20% of global liquefied natural gas. So basically a point of 20% of gas. So 20% of oil and 20% of gas. So as you can see, this is a very crucial place and a very crucial destination, or a passageway whereby 20% of the gas and 20% of the world's total oil consumption is being passed through that particular area. So as we know, the crude oil prices have spiked by more than $100 per barrel. So this would really affect the diesel prices, the jet fuel, the transportation all around the world. And whenever you're having your iPhone being transported from one country to the other, so during transportation, the prices are higher for Apple. So if the prices are higher for Apple, it is one of two things. Either Apple will pass this increase in prices and costs to you as an end customer, and so you would buy your iPhone instead of, let's say, 1,500, you're gonna buy it for $16 or $1,600. All right, so that's the main idea. Or the other thing for Apple to do is that they can digest this. However, their profit margins will decrease, and what happens when the profit margins decrease? Of course, the profits decrease, and that leads to a decrease in the share price. So what is really happening in this particular area is affecting everyone else. And the costs of shipping and air travel have really skyrocketed globally and around the world. So that is really the main idea of what is really happening throughout the world. So will this really affect your investment? Well, of course, we know that because of the increases in those prices, eventually, as we said, the costs will increase on those companies, their profits will decrease, and that would eventually lead to a lower share price. However, the real question and key question is, will this be a sustainable increase in prices, or will this just be a transient, a month or two increase in prices, and then everything will go back to its normal original price, and everybody will be back again happy, and things will continue smoothly? That's the real key question right here that I'm sure nobody can really answer, not even those who have the decision-making capabilities. So if we move on, this is really what us as investors should be really considering right here. So if we look at, for example, these companies, so we have the Magnificent Seven. I'm just going to mention the most, a couple of those. Actually, I'm just going to exclude Tesla right here because it has a different perspective. So if we look at Apple, Microsoft, Amazon, Meta, and Alphabet, Google, McDoodle, so you have 1, 2, 3, 4, 5, these 5 companies. And then you also have the 6th and the 7th company that make up the Magnificent Seven. So these 5 companies, if you look, for example, at let's just look at Alphabet. So as you can see right here, their gross margins, its trend over time, this is from 2021 all the way into 2025. As you can see, it is sitting at around 60%. If you look at this one right here, this is Meta, which have the highest gross margin, almost 80% or 81%. As you can see, they have a very, very nice and high gross profit margins. So, however, if you look at what is forecasted for these companies in their capital expenditure, what we really call CAPEX. So this is a growth percent on the y-axis. So as you can see right here, if we exclude Apple, we're going to talk about Apple in just a moment. However, if you look at Microsoft, Amazon, Meta, and Alphabet, all of these 4 companies, as you can see, their capital expenditure has been skyrocketing and reaching 300% increase year over year as compared to 2024. So really, their capital expenditure is increasing so heavily. And what happens when you increase your capital expenditure? Well, of course, your gross margins will decrease. And if the gross margins decrease, your net profit decreases. And finally, the share price and the market capitalization will decrease and follow as well. However, the other key question right here, not from an economic standpoint that we were just a geopolitical economic standpoint, but from a company standpoint, will these companies sustain this increase in capital expenditure for a couple of years? for their development of their AI businesses? Or will this be just a transient thing for a year or two, and then the and then the profits will pour later on from these AI investments? Or will we not be able to realize these profits until maybe 5 years, 10 years ahead? Well, if this is this is what if this is what's gonna happen, if let's say in 10 years you're gonna realize your capital expenditure, well, what is happening to these stocks? They are doomed. Why are they doomed? Because they are paying a lot upfront while they are not really making any profits for up to 10 years. So that's, lost money and lost the value of time. However, what Apple is doing right here is very different from these other companies. Maybe in 10 years, Apple will be obsolete. Nobody knows, because they are not really investing heavily in AI. However, what is happening so far is because Apple is not really spending so heavily on capital expenditure, well, their profit margins are expected to be kind of maintained. And that is why, if you look at Apple's share price, all right? So if you look at Apple's share price right here, over the past month, it was down by like 6%. However, if you look at Microsoft, for example, over the past month, it was down 9%, so that's more. And if you look at the kind of peak of Microsoft, it was down by 32%, a whopping 32%. But if you look at Apple's peak, so let's look at Apple's peak right here. So it was down by 13%. Of course, this is not a small number, 13%. However, Microsoft is down by 32%. So what is happening here is basically those companies that are spending so heavily on with a very high capital expenditure on AI investments, what is happening to these stocks is they are getting hammered so quickly as compared to these other stocks right here, Apple, for example, because they are not investing so heavily in AI and they are having these large expenditures. Now, of course, there are some companies that are profiting from that. For example, as you can see right here, Nvidia overall, it's up by 50% over the past year. AMD, although it was down today, however, if you look at the past year, overall, it's up by almost 90%. So these companies are really profiting from what's happening in this AI transition and this large capital expenditure. However, the idea is, if these other companies, like for example, as we said, Microsoft, Google, Amazon, and Meta, if they keep spending that much, then their profits will decrease, their market capitalizations will decrease, and this could potentially, as with economy, this could potentially have a ripple effect on the other stocks and the overall S&P and Nasdaq, as these magnificent seven really make a very large chunk of the Nasdaq and the S&P 500. So let's read what is prepared in the prepared marks right here. So tech companies, in contrast, operated with a very high margins and low capital expenditure. However, in the past, manufacturing companies required a high capital expenditure to build factories and the physical infrastructure. So you can think of companies like, for example, I don't know, supermarket companies that are really heavily reliant on building factories and physical infrastructure. For example, think of GM, or think of Ford, for example. So these companies, they build heavy factories, they build very expensive factories, and really need infrastructure in order to make and sell their vehicles and their products, and then eventually to eke out some profit margins with an eventual small profits. I mean, in terms of margins. However, if you look at the tech companies, in contrast, they operated with a very high margin and low capital expenditure. So they have gross margins, as you can see right here, 60%, 50%, 70%, or even 80% in the case of Facebook or Meta. So however, because given this increase in capital expenditure, what happens to your gross margins? Well, they go low, and if the gross margins go low, they can kind of be comparable to these other companies, for example, GM and Ford. Because if you really think about it, GM and Ford, they have a very lower price to earnings ratio, these ratios, as compared to these other high-tech, high gross margin companies, because whenever you have higher margins, higher profits, so higher price to earnings ratios. So for example, Meta can have easily a 25 or 30 price to earnings ratio as compared to Ford or GM, who have maybe 15 price to earnings ratio, or PE. So If these large magnificent seven are spending heavily and having lower gross margins, then maybe their PEs should not be 25 or 30. Their PE should be like 15, like GM and Ford. If this really happens, there is a very large decrease in the ratios, which would lead to a compression of the valuations, and then that will lead to a potentially bear market, which is losing 20%. So that is what is really feared for the upcoming years. That is what you should be really thinking and considering when you're particularly looking at your investments. Now, if we turn on to the next slide right here, so over the past couple of years, capital expenditure has significantly outpaced revenue growth across most companies except for Apple. So if you look at Microsoft, capital expenditure increase of 300%, while the revenue only increased 81%. Now, of course, don't understand me wrong. A 81% increase in revenue for Microsoft that is as large as this amazing company is a really, really big number. However, a 300% increase in capital expenditure is relatively way higher as compared to an 81%, naturally speaking. So the margins will decrease. And the same is as if we look right here, Amazon, Meta, for example, 270% as compared to 70% increase in the revenue. So that's a significant kind of, mismatch between the two. So other companies, Microsoft, Amazon, Meta, and Alphabet, reduced spending on acquisitions, scaled back or adjusted buybacks, and redirected capital toward AI investment. Now, of course, you can make the bet and you can make the hypothesis that these AI investments will hopefully later on pay back. However, what if these investments wouldn't pay back in, let's say, 5 years? Maybe they would need 10 years. I don't know. Maybe we have done some studies on that. However, nobody is sure 400%. So that's a real risk for these companies right now. Well, of course, my personal opinion, we will be reaping most of that investment within 3 to 5 years. However, is this investment for 3 to 5 years worth it or not? Overall, maybe so. However, you have to really be considering what your company's financials are, the management, if they really have demonstrated good decision-making capabilities over the past 5 years or over the past decade, and so on. So if you look at Meta alone, they used $6.3 billion in cash in 2025 in addition to operating cash flows. And then tech companies are shifting from cash-light models to capital-intensive structures requiring significant investment to drive AI growth. Now, I will go back just a tiny bit right here. So if we look at these different things, let me know what you guys think in the comments down below. If we're gonna really be hitting a bear market or will we not be hitting? However, if we really look back at NASDAQ, for example, if we look at the maximum number of years that we can see, from all the way in 1986, before I was even born, all the way into 2026. Now, I've started investing since 2018, and even if we look at the chart right here, whenever we've seen any type of pullback, correction, bear market, market crash, or even a recession, every single time the NASDAQ or the market was able to increase and kind of move forward from those levels. So the idea is, if you keep investing in the long term, you will definitely be able to make money. However, the question really comes is, for example, if you look at this period right here, so from 2001 all the way into 2011, as you can see, there were kind of zero returns from that time if you have invested in the peak of that time. Well, the idea is whenever they go down, you should always average your prices down. So for example, if we look at AMD share price, now a couple of days it was trading at around $190 or $195, I think, yesterday during the day. So that's a very nice point of entry or an increase in your position, in my personal opinion. Adobe stock, for example, I've been heavily increasing my investments in this company. Now the market cap is 95 billion. Their forward price to earnings ratio is like 10 or 11, and their current PE ratio is 13. So can you just imagine what is really happening to this stock right here? So all I'm trying to say is this overall really provides an interesting opportunity for us long-term investors to increase the positions of the stocks that we have really bought. Of course, You have to make sure that you have done your evaluations in the right way. The company's balance sheet is really strong enough to weather what is really coming in the next couple of weeks and in the next couple of months. I will end this video by asking you a couple of questions. So first of all, is this level of investment sustainable long term for these companies? We can see their capital expenditures, their revenue growth. I will answer you with that. Well, it is not sustainable forever. That is something for sure that I can say. However, is this sustainable for 3 to 5 years? Probably the answer is yes, but I don't think they will sustain this capital expenditure growth for 3 to 5 years. I think only for 1 to 2 years. That's my personal opinion. Second, will AI generate returns that justify this capital deployed, or will previous model of acquisitions and capital returns prove more effective? That's the key question right here. And then finally, I will end, will Apple be proven right, or will it fall behind, and Apple will kind of be something that we have talked about between 2008 and 2028, and then Apple is done and gone. Let me know what you guys think in the comments down below, and I'll see you in our next video.